Hi, everyone. You don't want to miss this episode. We're going to talk about what would I do differently between the ages of 18, 24 if I knew then what I know now. We get this question a lot from our clients or clients' kids that we talk to, so we thought this would be a great episode. So let's dig in. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina White. Christina, how you doing today?
Hi, Darren. I am doing great today. Very excited for this
Good.
topic. Sue, I think this is going to be a good one. How are you doing?
I'm doing great, and this topic actually came from a listener or client. How'd this come about?
Yeah, so I was chatting with my client the other day. He actually wanted to set up a meeting with his brother-in-law who's 19 years old. And he said, I was really thinking, and I was, what would I want to know? If I went back to 19, what would I want to know about? And I wanted to set him up with a couple of those things. I wanted to get him thinking about it, teaching him about it. And he said one of the first things I thought of was connecting him with you so that you could show him, all of that education session that we go through with all of our clients. So we sat down and did it. And at the end of it, I was like, you know what? This would make a really great podcast. Like this would be a good one. So here we are today.
I love it. Okay, any reminders before we go?
Yes, before we jump in, I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on socials at Control and Compound on Instagram and TikTok.
All right. Yeah, I'm excited about this one too, because behind the scenes at Control and Compound, we're kind of working on some education for kid-based stuff that we'll probably be releasing in a few months. And it is a question we get a lot from clients, or a comment we get a lot from clients. It's like, man, I wish I knew about this stuff when I was younger. I wish I'd started this 20 years ago. I wish I knew about this, or this. So I think, Christina, like a lot of things, it's no different than the regular clients we talk to. Now, everything we say today is going to be a little skewed towards. We work with a lot of entrepreneurs, business owners, real estate investors, but a lot of this advice will apply to everybody. But it might be a little skewed towards that because that's just our world and what we are. But it just goes back to, if you want to be wealthy, do what the wealthy people do. And we talk all the time in Control and Compound about this. If you want to be wealthy, there's 3 things really you need to do. You invest in yourself, you invest in a business, and you invest in real estate. If you think of every wealthy person, that's what they've done. Well, if you're a young person, the chances of you starting a business or investing in real estate are probably pretty slim. So it really boils down to investing in you. And I think that is the greatest investment you can make, is investing in yourself.
Absolutely, Darren. The best place that you can invest is always in yourself. Like, that's where you're going to make your number one return no matter what. And you might not think that when you're younger, right? When you're thinking of taking courses and you're deciding what you're going to do with your life, you're thinking investing is stock market, investing is Bitcoin, investing is all these other things. But what you don't realize is that you yourself are going to make a much higher return than any of those things are ever going to do for you throughout your lifetime. Think about what your income is going to make between 19 and 60 on the day you retire. That's a huge amount of money that's going to be coming in, and that's based on you and the investment in yourself. So every time you take a course and you better your knowledge, you get coaches in different things, like any betterment of yourself. And I don't even just mean, I'm not talking university and stuff too either, right? Like, if you want to better yourself in health, if you want to better yourself in finance and real estate investing, all those different things, you want to start with you and build your way up from there. Absolutely.
Yeah, I mean, you think of, if you have say a 40-year career and you're making $50,000, well, that's $2 million over your lifetime. But if you can do something to say, no, I'm going to make myself better. I'm going to learn a skill. I'm going to take a course. I'm going to do something that grows me. And you can make that 50 into 100. Well, now instead of $2 million over your lifetime, that's $4 million over your lifetime, or maybe $8 million over your lifetime. So it's really, this is the sweet spot for young people, because you probably don't have a spouse and kids and a mortgage and all those other things going on. So all your time, a lot of your time should be, how do I make myself better? How do I learn something new? And even from the job perspective, like I tell young people, take a job to learn, not to earn. Like, I remember reading in high school, it was a guy that he said, you got to choose the right industry if you want to be wealthy. So he wanted to become a venture capitalist. And he goes, I basically went and was the coffee boy for this venture capitalist for the first year and made no money. And all my friends made fun of me. But the guy's a billionaire now because he chose an industry that he could work his way up. I mean, I remember when I graduated from my MBA in the 90s, a lot of my classmates were getting jobs at the provincial government and federal government. And, they were making like 48, 50 grand a year. And I started at $26,000 a year. Now, living downtown Toronto at $26,000 a year, my first job after my MBA, is not a lot of money back then. Not a lot of money today either. But what happened was I chose an industry and I chose to continue my education in that industry and get different designations. Well, in about 2.5, 3 years, I was making 100 grand, and my friends of the government, got raises up to $52,000 or $53,000. But I chose an industry and I chose to continually to invest in myself. And I mean, we tell the story all the time, but we get some young clients in their 20s that, took real estate courses, joined real estate groups, got coaches, and were able to buy buildings in their early mid 20s when all their other friends were out, partying and spending all their money on different things. So that time to invest in yourself, you've got all the time in the world when you're young. You don't think you do, but you do have all the time in the world. Just dedicate, like, what can you learn on YouTube? What can you learn for free? What books can you read? How can you improve your mindset? How can you improve your physical fitness that will allow you to perform better in a job? So, I ran into a friend of mine's son the other day, and he was asking me, what should I do? And he was a 20-year-old carpenter. And I'm like, you should learn every single thing you can about the housing construction. Like, if his grandfather was a home builder, his dad was a successful business owner. I'm like, look what your parents and grandparents did. They invested in themselves and they started their own businesses. But before you start your own business, you need to learn some stuff to be able to start a business. So don't look at your job as how much do I make? It's how much can I learn at that job? What other skills can I learn? And I think that's just like, I know we spent a lot of time on investing in yourself, but there's no greater thing a young person can do is try to make yourself better, level yourself up. That'll mean millions and millions and millions of dollars. Don't get hung up on the latest crypto craze or whatever, doggy coin or whatever's going out there. Invest in yourself.
Absolutely. Take the time to learn it though, right? Take the time to learn about all of it because you have the time to do it. Take the time, learn about it, and build up that investment in yourself. So no, I absolutely, that's the foundation of it. So we want to jump into more basics of finances now. And okay, so some of those things. So one of the things that I wanted to talk about is creating assets versus liabilities. And I wish someone would have told me this when I was younger, but assets put money into your pocket, liabilities take money out of your pocket. And there's a lot of things out there that we might assume to be assets when we are younger that just don't quite qualify when we use that definition. So things like cars, four-wheelers, campers, all those things that you might in the back of your mind think, hey, it's an asset, right? It's worth money. I've paid for it. But those things don't actually put money back into your pocket, right? So that's something to think about when you're building up your assets. Think, is it putting money back into my pocket or is it taking money out? And if it's taking money out, then it's not growing your net worth. Unfortunately, we can't put that on the asset line. Also, when it comes to that, a lot of people do think, and it is to a degree, but the home that you live in, right? So the home that you live in technically takes money out of your pocket, unfortunately, right? Takes money out of your pocket. There are ways around this though. And this is something I really wish I would have done going back those years, is a house hack, right? Like if you have the ability to purchase a duplex, for your first home, instead of maybe purchasing that expensive single family home or purchasing another regular style home, I would go for a duplex, right? If you can live in half and rent out the other half and have that other half pay your bills while you're living in there, well, that's going to create an asset for you long term, right? There's money coming out of that. So there are ways to think differently about that first house purchase, and that would be one of them. So that would be something that I definitely look back at.
Yeah.
Another one, pardon?
Yeah, I was going to say, like, you can buy even a 3 or 4 unit, and you can have a 2 or 3 bedroom place and rent the rooms out, and then rent the other unit or two out. Like, yeah, my hope is my kid's first property is a multiple door property, so they can start that from day one, and it's not much different to buy a or a couple units than it is a single family. If you're smart about it.
Well, yeah, and if you're okay with it, right? If you're okay with not having that big home with the big garage and everything else, you got to start with the basics and work your way up, right? And a house hack is a perfect way to do it. So that's something I wish someone would have told me. Another one on that are these deemed assets like fancy cars and things like that. Those in You want to avoid impulse purchases, especially when they're large purchases. So if you're purchasing a vehicle, if you're purchasing something that is, pretty expensive, do not do it day one. My rule, and I actually follow this, is 30 days, right? You've got 30 days to decide if you're going to do it. And if at the end of those 30 days, it's not quite as exciting, maybe you shouldn't have spent your money on it, right? Might not make sense to do it. So you want to think about those things. There's a lot of I don't see a lot of very wealthy individuals driving fancy Lamborghinis. And, well, there are, but you got to hit the $1 billion status to get there. You're not talking when you're building up your wealth, you are not putting all your money into a car. That is not a great investment. Like I said, that's taking money out of your pocket instead of putting money into your pocket. Some of the wealthiest individuals I know drive, 30, or I don't know if it's 30 years old, but they look like it, like beat up old pickup trucks, right? Like beat up old pickup trucks, old vehicles, because they know that they get the job done, and they know that that truck is putting money back into their pocket, because that's what's getting them from job to job and making the money for them. So that's how you want to think about it.
Yeah, I think cars is one of the ones that frustrates me the most, because I see young people with a fancy car, and trust me, the only people you might be impressing is your friend group and the people your age, because the older people, especially the older successful people, what they would appreciate a lot more is if you were grinding, if you were investing in yourself, or maybe trying to buy a property instead of a car, and driving an old car. Like, I talked to a client of mine, been a client for years, and he's a very, very successful person, like hundreds of doors of real estate. And I called him one day, and I'm like, "Hey, what's going on?" And he's like, "Oh, just living the multimillionaire dream." I go, "Oh yeah, what's that?" He goes, "Well, I got a 12-year-old truck here with 2 used washers in the back, about to go sub them in on a couple of my units, living the dream." And it's funny when you see these successful people, like, they would rather put their money into an asset that's going to generate something than put it into a fancy car. And once you achieve a certain amount of wealth, sure, go buy your car. But when they were getting to that point, they're not buying the fancy cars, and some people just never get to the point where they can justify spending a couple $100,000 on a car. But the same thing for a young person, spending $60,000-$70,000 on a fancy car when you don't really, have money long term. You haven't invested in yourself. You haven't started a business. You haven't done real estate. You don't have an emergency fund. So, cars is the one that just drives me crazy. Okay, let's get into avoid lifestyle inflation. So this is a classic one. You're making X, and all of a sudden you get a raise, and you think you can spend more money. Okay, well that's not it. Or you get to a point where it's like, oh, I want to do this now, and then what's Nelson's line? A luxury once enjoyed becomes a necessity. So it's like, oh no, I only play Pro V1 golf balls at $3 a ball or whatever, and it's like, oh, okay, like there's no going back from there. Once you start doing something, it's hard to go back. So just really watch that lifestyle creep. As your income increases, it's natural to want to spend more money, but you really got to focus on, every time you get a raise, how do I reallocate that money into a savings, instead of, like, I used to get my bonuses, and it's all the bonuses would go into savings or an investment or something I had to buy at some point, instead of saying, "Woohoo! I got a bonus. Let's go spend it all."
Yeah, and the more you can automate it, the better it is. So if you get paid monthly, you should really be setting up automatic transfers directly from your account to wherever that savings is, no matter what it is. I always tell people, if you don't pay yourself first, It's not going to happen, right? If you wait until the end of the month to go put that savings away, there's a very good chance that those savings aren't going to be there. So the moment you get paid, the first thing you want to do is get that money out of the regular account and put it into your savings account, whatever that may be. But that's you want to get it out of the account immediately and then focus on, just spending within your means, a good lifestyle, but don't let that creep up, like you said, right?
Yeah, you're right. If it's in your account, you're going to spend it. So I love that. Separate. I don't care if it's a high interest savings account. I don't care. Just get it out of your main account. Okay, Christina. Another big one is credit. Let's talk about credit for a while.
Yeah, this is a big one. I wish when I was 18 years old, someone sat me down and was like, "Hey, this is your credit card. This is your credit report. This is how you build your credit report." Nobody did that, eh? Like, I don't remember that lesson. And I got that credit card at 18 just the same. So going back in time, what I would tell myself when it comes to credit and creating good credit's very important. Right? Like throughout your life, there are going to be numerous things that pop up that you need good credit for. So establishing that early is very important. You can, at 18, 19, go out and get yourself your first credit card. And I encourage you to do it because the moment you get that credit card, the moment your credit starts building. A lot of young people think, if I get the credit card, I might spend it. That's not a good thing. I'm going to hold off until I actually need it. Not a great idea. The sooner you get one, the sooner it starts building. What you do want to do, though, is never miss a payment. So if you miss a payment, if you're late by a couple days, that impacts your credit negatively. So you don't want to carry a balance. You want to maybe decide, I'm going to put all my gas and I'm going to pay it off immediately. Like I'll literally pay for the gas at the pump. I'm going to sit in my car and I'm going to automatically transfer the money to the credit card the moment I get in the car. Money's in the checkings account. It's going to the credit card. Whatever you have to do, but make sure that you pay that off at the end of every month. Because carrying a balance is going to create the interest, which we're going to talk about in a minute. But a couple other things on credit that I wish I would have known. Carrying a balance does not create a better credit score. So a lot of people have it in their head that if I have a balance on my credit, on my Visa, I'm going to have a better credit report. No, that's not correct. You don't need to carry a balance. And you should never, if you need to, never carry a balance that's over 30% of the overall cart. So if you've got $1,000 credit card, if you're over $300, you're now utilizing too much. That's going to impact your credit score as well. So something to keep in mind. Always pay it off if you can. Absolutely. Another big one is avoiding closing your oldest account. So if you open that account at 18, that small credit card, you might think at 25, hey, I've got this new credit card that's got a bigger balance on it. I'm just going to cancel that old one, keep the new one. Don't do that because that shows credit history. So the longer you have that credit card, the better it's going to look long term. And then when you're applying for new credit, so if you're going out and you are trying to get that new car, you're getting a loan for a camper or whatever it is that you're buying, or you're going to Leon's to get furniture, whatever it is, they're going to ding your credit score to make sure that you have a good credit. And that's going to impact your credit report negatively. Every time a new application hits, it's going to ding your credit. So be cautious of these things, right? If you can keep these in the back of your mind, it's important. The way to keep them in the back of your mind is to monitor your credit. So I highly encourage you, once you get that credit card, to also go set up one of those. There's free accounts everywhere, Credit Karma or whatever it is. There's lots of them out there. Google a credit tracking report where you can go in and you can see what's happening and take a look at it. And you should feel proud of yourself as it grows. That's a huge accomplishment. So keep track of it and make sure that you're, doing all those right things. And it is going to pay in tenfold later on when you go to make that first big purchase, get your home, do that house hack.
Yeah, I love it. Just one comment on the credit card there. You should get a credit card if you can pay it off every month, right? It's kind of like a line of credit on home for people. Like, yeah, great, line of credit's great, unless you're not disciplined and you're just going to run up for vacations and fun activities and stuff. Same with the credit card. If you're an 18, 19-year-old who right now, you're just not disciplined and you're not going to pay that credit card off, maybe hold off a little. But checking the credit score, Christina, that's the great point, because so many people either don't know their credit score or don't routinely check it. And back to that investing in yourself, like this is only 5-6 years ago. I remember being at a conference and they were like, oh, here's a free way to check your credit or whatever. And I literally did it while I was sitting there on my phone at the conference. And then of course I'm on their email list. So I get email scores, and I was getting emails like, your credit is going down, and I was down this month. And I was like, pay off all my bills, but doesn't make sense. And It was, as control and compound grew, just every month the credit card I was putting more stuff on the credit card. I was paying it off every month. But to your point earlier, I was getting to a point where I was using a higher percentage of my available credit, and it was hurting my credit score. And I was like, what do you mean? I'm paying it off every month. How can it be hurting my credit score? But it's the utilization. So again, if you don't track your credit score, you're not gonna notice those things. So I increased my credit, and it's great. It's great now. But it was like frustrating going, wait, I'm doing everything right. Why is my credit score going down? So that's huge. So the next one, Christina, we talk a lot about this all the time, the compound interest. Einstein said it's the eighth wonder of the world. Those who understand it earn it. Those who don't pay it. So I thought we'd show an example, Christina. Why don't you tell us what this example we're going to see on a 19-year-old just every month putting some money away?
Okay, so we're talking about the good compound interest first then, right?
Okay,
Good.
yeah.
Good because it can go both ways. We'll talk about that one next with the with interest rates and whatnot on those Visa cards.
Well, we can talk about that right now. I like that example. Let's talk about the credit cards.
Yeah, so I do think that's important too for you to realize. So when you're talking about that vacation and you might not be good at paying off your credit card, I'm hoping that this example stops you right there, because if someone would have given me this example, might have stopped me right there too. So we ran the numbers on it this morning, and we looked at it. You put $2,500 on a credit card. So let's say you take a very expensive vacation, you throw $2,500 on that credit card, and it takes you 3.5 years to pay that back at a 20% interest rate, which is pretty typical on a credit card. It's going to cost you $2,500 for that purchase. So you've literally paid what you spent in order to utilize that ahead of time, right? Instead of that's crazy. And that's compound interest working against you, because what happens with a credit card is that balance that you're carrying over. It's not like, that 2,500, you're not just paying interest on 2,500 every single month. Every month that's going to get bigger. So that 2,500 is going to grow, and you're going to pay the 20% on that. Then you're going to pay the 20% on that. Then you're going to pay the 20% on that. That's compound interest working in the opposite direction for you. We love compound interest on the other side. On this side of things, it can really, really be a world of hurt when you look back at the numbers and what you're going to be spending on those credit card payments.
So just to be clear, $2,500 purchase on your credit card that you take 3.5 years to pay off cost you $5,000, not $2,500.
Yeah, exactly, Darren. $5,000. That's insane. For your $2,500 vacation, you've spent $5,000. So think about that when you open up that credit card and you want to start using it. Now, let's go back to compound interest as a good thing for those that understand it, right? So we're talking about the high cash value policies that we talk about, that we use for infinite banking, and what that looks like for, and we're going to look at a 19-year-old example. And I always tell people, when they ask me, for someone that's younger, like, why it must be so much better. Why would it be so much better? Time. It's all about time. They have so much more time for their money to be compounding on that curve. So they could actually start with smaller amounts and they get really, really big. So if we're looking at an example that I have here using the high cash value life insurance that we talk about regularly, brought it down to a $500 monthly deposit for a 19-year-old male is what we're looking at. So at a $500 monthly deposit, is going to take time to get going. It's like that snowball that we talk about, right? Compound interest does take a bit of time to get going, but as it grows, it gets huge. And what ends up happening here is you're putting $6,000 in a year. By the time you're at year 20, you're at 176 grand. By the time you're at year 30, you're at 381,000. And by the time you're at year 45, which you're going to be 64 years old going into retirement, you're going to have $1 million in cash value in this account. Now you've put $270,000 into this, right? And you're at $1 million, which is amazing. that's great. And that's the beauty of the compound interest. Now, a lot of people will say, but, you can do that if you get X amount percent of rate of return, a 5% rate of return. But what ends up happening for a lot of younger individuals is that if you have to take money from the accounts, you're going to stop that compounding. That $1 million won't be there, right? So you're putting $6,000 in every single year. And then in year 10, you've got 55,000 in there, let's say, and it's time for you to go do that house hack. You want 40 grand to go put it in. Well, now you've pulled in a traditional investment, you're going to be pulling that 40 grand out and you're going to be left with what, 15 grand. That's now going to be compounding. So you've thrown yourself off that compound growth curve. You're not going to hit $1 million anymore. It's just not possible, right? Because you've pulled that $40,000 out. With this, because it's staying in there and it's compounding year and year, you've got that wonderful compound interest I guess the key here is uninterrupted compound interest working for you, which is going to lead you to that $1 million at retirement. And when I look at this, I'm like, my gosh, if my mom told me that I could put $500 a month into something and I'd have $1 million for retirement, I'd be all over that. I would be all over that, which is all about that time in one of these policies, right? It's incredible.
Yeah, and that's just one policy. Obviously, they can have more, and that comes with that 65 or 64, a $2 million death benefit too, right? We didn't even focus on the death benefit, but it will be relevant when you're 64 years old. Christina, let's stay on the compound interest and talk about why people don't get compound interest. Because if you think of compound interest like that hockey stick curve, right? So the early years, you don't earn a lot. And the whole idea is you want to stay on the compound interest curve because in the later years, you earn a lot more. And, you've heard us talk about this over and over and over again, but they're so important. The 4 wealth destroyers that knock you off that compound interest curve. If you want to stay on that compound interest curve and be wealthy, you need to manage the 4 wealth destroyers, almost more important, other than investing in yourself, almost more important than anything. Managing the 4 wealth destroyers allows you to stay on the compound interest curve. The number one is tax. If you don't manage your tax, it's going to be hard to stay on the compound interest curve because every year you're going to be paying tax on that investment, taking money off, lowering that compound interest curve. You got to manage the fees. You want as low fee as possible. You got to manage volatility. Ups and downs of the market can crush you short-term and long-term. And then the big one, especially for younger people, but for all people, is spending. And that's kind of what you talked about, how you can create this and asset with cash value life insurance. And again, we're not going to spend too much time on cash value life insurance here. This is one of the places you need to save. If you don't do this, save your money somewhere. Just put that $500 a month or $1,000 or whatever you can. And every time you get a pay increase it, separate it in a separate account. We think cash value life insurance is great, but if you don't agree, that's fine. Do a high interest savings, something that isn't too volatile, to build up a fund that you can use for investing in yourself and maybe a business or real estate opportunity someday. So staying on that compound interest curve and avoiding those wealth destroyers is huge. And then, Christina, what about control?
Yeah, control is a big one. And this one is, again, something I wish someone would have told you way back. You need to have control of your money in order to do any kind of investment, right? If you want to purchase a course for yourself, if you do want to purchase a home, if you want to purchase any kind of investment out there, really, like it's endless. You need to have control of your money to do that. There's certain vehicles where you can save that give you more control, and there's certain vehicles that do not have the control. And what a lot of young people might not understand is the difference in how these vehicles, these savings vehicles work, right? So it's not, you can invest in the stock market in any one of these vehicles. And a lot of people think I need an RSP to be able to invest in the stock market, let's say. No, that's not correct. There's lots of different vehicles that we can use. It's all about choosing the right vehicle for you. And an RRSP is one that, you've heard your parents talk about, you've heard the banks talk about, and it's like, well, that's where I must have to, it says retirement right in the name. That's where I have to save for my retirement, right? It's just, that's the mature thing to be doing. But there's a very good chance that it's not the right vehicle for you. And I can almost guarantee you, if you are just starting out in the, if you're just starting out in the employment world and you're just starting to make money, you are at the lowest tax bracket that you will ever be. And what happens with an RRSP is you're deferring tax. So that's huge. You're not deducting, it's tax deductible at the end of the year, but it's actually deferred. You're going to pay that later in retirement. So the whole strategy behind an RRSP is that you defer the tax in a really high tax bracket to pay it in a lower tax bracket. Now, I don't believe that works out either, but I'm not even going to go down that road. My point is, if you're at the lowest income you've ever been and you ever will be, then that strategy doesn't work at all, right? Because you're not putting money in the highest tax bracket. So when someone recommends that a new person just getting into the employment world, their career, starts putting money into an RSP, now, if it's a matching program or something through your work, that is free money. So take your free money through your matching program. Don't get me wrong. It's the additional above and beyond a matching program where it probably is not going to make sense for you because that RRSP strategy doesn't work. And there are other vehicles that are more that are going to be better equipped for what you're trying to do, right? Whether it be the high cash value life insurance, whether it be a first time home savers account that they have now, a tax-free savings account, high interest savings account. Do your research on the investment or the vehicle that you're storing this wealth in. Don't just assume because it says retirement in it, it is the best strategy for your retirement. There's going to be different places to do that. And that control piece, I guess I kind of got off tack on that control side, didn't I, Darren? But I wanted to share that too, because I think it's really important. Sorry.
Yeah, no, like, and just one comment on RSPs. Again, we're not super excited about RSPs because we're dealing with entrepreneurs and real estate investors. Because you can't invest in yourself, your business, and real estate with RSP dollars. Now, for those people that are going to be a school teacher or government worker that want to, what I don't want to encourage people to do is, I don't need to save in RSPs now. I can blow my money. No, if you're not going to set up a systemized savings plan for the money you otherwise would have put in RSPs, then do it at work and put your money into RSPs. But if you can be disciplined to say, no, I'm going to take that money and I'm going to put it in a different savings vehicle where I can access to invest in myself, to invest in my business, to invest in real estate. Because I think spending a few $1,000s in your 20s making yourself better is going to be a lot greater return for you over the next 40 years than putting a few $1,000s in an RSP and waiting 50 years until you're 70 to turn it into a RIF. I would rather young people put that money in an account that's outside of their spending account, their checking account, and then get to a point where they can take that and invest in themselves, whether it be cash value life insurance where they multiply it or a TFSA or a savings account, don't care. Just put some money aside so you can put it into there. But I do RSPs because that's what everyone's supposed to do. Think it through.
Yeah, absolutely. Thank you for pulling that control back. I kind of got on a rant there. It's just it's the education piece, and it's going back to the education piece. So for younger individuals, this education's not given to you, right? You're not learning about this in school. So it is up to you to go out and find those resources. If I could go back in time and hand myself a couple books and say, listen, read these immediately, even before 18, if possible, I tell myself 100% go out there and read Rich Dad, Poor Dad by Robert Kiyosaki. We actually have a full podcast on that one if you want to check it out. Obviously, read Be the Bank by Darren Mitchell. Like, come on, that's a foundational book. And as well, What Would the Rockefellers Do by Garrett Gunderson. That was one of my favorite ones as well. Kind of learning from the wealthy. We always say that if you want to be wealthy, do what wealthy individuals do. And they take a lot of time to read. And these days, everything's on ebook or podcast. Like, education is so accessible now that there's no reason why you wouldn't want to kind of take advantage of all those resources.
Yeah, and it doesn't have to be an investment in, I'm taking a course on finance or real estate investing. You can take I remember when I was in my 20s, I joined Toastmasters. Like,
It's a good one.
I don't think that cost anything or a couple bucks or something. Well, that was Toastmasters. Well, that made me a better presenter. So, 22 years old, didn't have a family. I was working in Toronto, and it's like, I got time. Why don't I Tuesday night do Toastmasters? So do Toastmasters, or you can do personal development. Follow Tony Robbins and go to an event or read one of his books, like something just to make yourself better. And then, if you do have a business, there's all kinds of great books. We're going through the EOS with Traction now, but I love the E-Myth on how to modelize your business. But if you're starting out, focus on yourself and your education. So, Christine, if we kind of wrap this up, if I was going to say to a young Darren, what would I do? Well, I've got a young Jake and a young Natalie, my two kids, and in a perfect world, what do I want for them? I want them focused on, in their 20s, how do I make myself better? How can I learn the most skills possible that's going to help me earn a higher income the rest of my life? So number one, just massively overinvest in yourself as much as you can. Learn from everyone. Learn. attend workshops, attend webinars, whatever you got to do to learn, make yourself better. If it's a specialized skill, get it. Okay. That would be number one. As far as the savings, I love cash value life insurance. I love TFSAs, and I love investing in you, your business, and real estate. So if you want to save money, I like cash value life insurance. I like TFSAs. I like investing in you, your business, real estate. That's going to enable you to be in control of your money, to take advantage of opportunities. And it's the proven, time-tested way to get ahead. So invest in you, business, real estate. Number one, invest in you as young people. Anything else, Christina, before we wrap up?
I just want to add one thing, and it's because we've been working on it and building out, adding it to part of our education series. Is I do think that creating value in this world too, right? Tying that back into all of this, because investing in you is going to give you the skills to be able to create value in the world. So when you look at things, look at them, is this going to create value for others? Because I can tell you that it will come back. Creating value is going to creating value in this world is how you're going to make money long term. It's how you're going to create generational wealth. It's how you're going to create all kinds of opportunities for yourself. If you go out there and you start with the focus of creating value for somebody else, for creating value for others, that's going to come back. That is 100% always going to come back to you. So as a young individual, put yourself in a mind space where every conversation that you go into, you're also thinking, how can I create value for that other? So can I sit down with this mentor and learn more? Because I think that's another one, sitting and finding individuals, surrounding yourself with individuals that do the same things that you want to do. You surround yourself with wealthy individuals. If you want to be an entrepreneur, surround yourself with entrepreneurs. That's super important. And when you're in that room with the entrepreneur, try to think how you can create value for them. Because I promise you that is, and it doesn't have to be monetary value. I mean, any kind of value that you can create in this world is going to come back to you tenfold.
Yeah, I love that, Christina. Creating value. We're going to do a lot of stuff on that in the future. Right from little kids, if you want something, you need to create value, right? If you think you're underpaid as a young person at your job, you need to create more value. You need to create value. You need to go in a little early and you need to stay a little later. You need to show that you're creating value and that your contributions are more valuable than what you're getting paid. That's how you get raises. That's how you get ahead. That's how you get promotions. When I was 22 years old working in Toronto, my boss would come in the morning and he'd turn the lights on and say, "Morning, Darren." And he couldn't see me. My office was down the hall, but it was 5:30, 6 o'clock, and he knew I was going to be there because I was the first one there every day. And guess what? That stuff pays off. That gets noticed. If you create value at your job, you're going to get ahead, and the people that don't create value aren't going to get ahead. So that's it. What I wish I knew when I was 18 to 24. Hope you enjoyed it. Thanks for watching. Thanks for listening.
Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.